So it's the last trading day of the first week of March. I wonder how the market is doing. March has started off in an interesting way. With the market being down, we can get opportunities to buy undervalued stocks. So let's dive in. As always, make sure to check out the disclaimer in the description down below. Welcome to the channel. We're going to take a look at 3 possibly undervalued companies. Today we're going to be using a Gordon growth model to value our stocks. The Gordon growth model is a simple way to value dividend stocks by assuming dividends grow at a constant rate forever. It estimates fair value using this formula. While easy to use, it's sensitive to small changes in growth and discount rates, so apply it with caution. If you're interested in how to build this simple valuation tool in Excel in under 10 minutes, make sure to subscribe and hit that bell icon to get notified when I release my upcoming tutorial on how to set up your own quick valuation tool. Let's jump into the first one. HPQ, HP Inc. A leading American technology company known for its personal computers, printers and related hardware. HPQ generates revenue through hardware sales and printing supplies with a strong presence in both consumer and enterprise markets. Let's head over to Seeking Alpha. You can see the company is yielding around 3.8% with a dividend of $1.16. Looking at their dividend growth, we see the 3, 5 and 10 year, 10.3% for the 3 years, 11.19% for the 5 years and 14.67% for the 10-year growth rate. Very impressive. Going over to their payout ratio, we can see their earnings payout is at around 40% and their free cash flow payout is just under 30%. So plenty of room to hike the dividend. It's a relative safe payout ratio. Taking a look at the dividend history, we see they have a 14-year streak with their dividend hikes, and they actually paid dividends consecutively for 35 years. So let's jump into the valuation page and just enter HPQ and type in the dividend. Now, for this example, we're going to use 4% growth. Why 4%? This model is kind of flawed, since the valuation is based on growth in perpetuity. So I'm going to be a bit more conservative. I'm going with 4% growth, 8% discount rate, and a margin of safety of 5%. And as we can see, it's fairly priced for an 8% return based on our assumptions without a margin of safety. If we just use the 12% average from the dividend history, we can see it make things go bonkers. Like I said before, this tool is flawed, but it can be used to know if we have to do further research. And by doing an analysis for 5 to 10 years, we can be a bit more generous with the growth rate. Next up is ADM, Archer Daniels Midland, a global agribusiness and food processing company. ADM is involved in the sourcing, transportation and processing of agricultural commodities like corn, soybean and wheat, playing a major role in food production and biofuels. Looking at Seeking Alpha, we see the dividend here, $2.04. And let's check their dividend stats. 3, 5 and 10 year. We got 10% compounded annual growth rate for the last 3 years and around 7% for 5 and 10 years. They did stellar during the inflation period and they expect headwinds for 2025, so keep that in mind. Looking at their payout ratio, it sits at about 55% for the earnings and 33% for the free cash flow. Checking their dividend history, we can see their consecutive years of growth is at 31 years, and their consecutive dividend payments is sitting at 49 years. But this is simply wrong. And here's where things get interesting. Looking at their presentation, they have paid consecutive dividends for 92 years and have hiked their dividend for 51 years, making them a dividend king. Alright, we're back at the valuation page. We enter ADM and the dividend 2.04. Taking their history into account and the essential sector they operate in, let's assume 5.5% growth for the dividend long term, say 2 to 3% from inflation and 2 to 3% from growth of their earnings and cash flow, using a 10% discount rate, and we land at a fair price targeting around a 9.5 to 10% return before factoring in a margin of safety. If we adjust the discount rate to 7.5% and the growth to 3% to be a bit more conservative, we get around the same levels. So it all depends on the growth. Alright, let's head over to Europe. Rubis, a French company specializing in energy distribution and storage. Rubis operates in fuels, LPG and bitumen, with a strong presence in Europe, the Caribbean and Africa. The company focuses on infrastructure for fuel storage and distribution, catering to both industrial and retail markets. Since this isn't on Seeking Alpha, we have to do some legwork and try to find out some stats. They have hiked their dividend for 27 years, with the 10-year compounded annual growth rate almost touching 8%, and the last 5 years has been at around 4%, and their payout ratio is sitting at around 60%. And the dividend yield is 7.5% currently. So, we punch in the ticker and the dividend, 1.98. I'm going to put a low growth here. The energy sector will take a hit if we go into a recession. Let's use 2.5% growth, 10% discount rate and 5% margin of safety. And bam, 10% return with very conservative growth numbers. You should always see how taxes impact your investments. Even if I pay a withholding tax, I get all the tax back the year after, so I don't discount it. For you, it may be different. So, just as an example, let's remove 15% from the dividend. Then we would need above 3% growth to make up for that. So, there you have it. 3 discounted stocks you can do further research on. If you found this video helpful, consider subscribing for more dividend stock investing. Your support helps me keep delivering quality stock analysis, so smash that subscribe button if you found this video helpful. I'm the Swedish dividend investor, and I will see you in the next one. Stay smart, stay patient, and keep stacking those dividends. Ha det gött!